Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia. Today's episode is all about forex, the world of currencies. We're diving into the Federal Reserve's outsized influence on the dollar, how currency strength affects exports, and one of the most fascinating strategies in the forex playbook, the carry trade. If you've ever wondered what's the best currency pair to trade today, or how shifts in currency strength can tilt global trade, this episode is going to be packed with insights for you. So let's get started. Segment 1: Why Forex and Why the Dollar Matters. Forex is the biggest financial market on earth. Over $7 trillion move through it every single day. That's not a typo, 7 trillion. It dwarfs equities and bond markets. But what makes Forex special is that you're not just trading companies or bonds, you're trading entire economies, monetary policies, and even geopolitical events. At the center of it all is the US dollar. Roughly 90% of all forex transactions involve the dollar. That's because it's the world's reserve currency, the backbone of global finance. And who controls the dollar's direction? The Federal Reserve. Segment 2: The Fed's outsized role in forex. The Federal Reserve isn't just America's central bank, it's the central bank of the world in many ways. What the Fed does with interest rates, liquidity, and forward guidance affects not only the dollar, but also every other major currency. So let's talk about the three main ways the Fed moves currencies. First, interest rate changes. When the Fed raises rates, U.S. assets, like treasuries, become more attractive to global investors. To buy those assets, investors need dollars, so the dollar strengthens. Conversely, when the Fed cuts rates, U.S. assets yield less, capital flows elsewhere, and the dollar weakens. Second, balance sheet policy, quantitative easing or tightening. If the Fed engages in QE, injecting dollars into the system, it often weakens the currency by creating excess supply. If it tightens, what we call QT, it usually strengthens the dollar by reducing liquidity. And third, forward guidance. This is where the Fed signals its future intentions. Sometimes just a phrase like higher for longer can move trillions in currency markets because traders act on expectations, not just current policy. Let me give you a concrete example. In 2022 and 2023, the Fed launched its most aggressive rate hiking cycle in decades to tackle inflation. The dollar surged to 20-year highs. Euro to US dollar dropped below parity for the first time in 2 decades, while emerging market currencies like the Turkish lira and Argentine peso collapsed under pressure. So, if you're asking yourself what's the best currency pair to trade today, your first step is always to check the Federal. Segment 3: How currency strength shapes trade. Now, let's shift to something that connects Forex directly to the real economy: how currency strength affects exports and imports. Here's the dynamic in simple terms. A strong currency makes imports cheaper but exports more expensive. A weak currency makes imports more expensive but exports cheaper. So if the dollar is strong, American consumers benefit because imported goods are cheaper. But American exporters, like farmers, tech companies, or machinery makers, suffer because their goods are more expensive overseas. Take Japan as an example. A weak yen boosts car exports from Toyota and Nissan, making them more competitive globally. But Japan imports a lot of energy, especially oil, and a weak yen makes those imports more expensive, hurting households. Or consider the Eurozone. A strong euro helps reduce inflation by making imports cheaper, but it makes German machinery and French wines pricier for foreign buyers. And for emerging markets, the stakes are even higher. Many rely on commodity exports, so weaker currencies help make their goods more attractive globally. But they often borrow in US dollars. So when their local currency weakens, paying back that debt becomes more painful. For traders, this is gold. Watching how currencies impact trade balances can highlight opportunities. A country whose currency weakens but whose export sector is robust might present a profitable setup. Segment 4: Carry trade strategies. Now let's get into one of my favorite topics: the carry trade. What is a carry trade? It's when you borrow in a currency with low interest rates and invest in one with higher rates. You pocket the interest rate differential, the carry. Let's make this concrete. Imagine borrowing in Japanese yen, where interest rates are near zero, and investing in Australian dollars, which might offer 4 or 5%. Every day, you earn that interest spread. And if the Australian dollar strengthens against the yen, you profit twice, once from the carry and once from the currency move. This is incredibly attractive in stable times. Investors chase yield, and inflows into high yielding currencies can even push them higher, creating a self reinforcing cycle. But here's the catch: carry trades are not without risk. They can blow up fast. If global sentiment shifts, investors stampede back into safe havens like the dollar or the yen. That sudden move can erase months of carry trade profits overnight. This is why Fed policy matters here too. If the Fed raises rates aggressively, suddenly the dollar becomes the new carry trade king, drawing capital away from other high yield currencies. Historically, the yen carry trade is the most famous example. For decades, traders borrowed yen at ultra low rates and invested in higher yielding currencies. But during crises, like the 2008 financial crash, those trades unwound violently as money rushed back into yen, creating massive market swings. Segment 5: Combining Fed insights with carry trade opportunities now. The smartest forex traders don't just look at the Fed or just look at carry trades. They blend both approaches. If the Fed is hawkish and the dollar is strong, traders might short currencies like the euro, the pound, or weaker emerging market currencies against the dollar. If the Fed is dovish and the environment is stable, traders might look for carry trade opportunities, such as pairing high yield currencies like the Australian or New Zealand dollar against low yielders like the yen or Swiss franc. The point is, the best currency pair to trade today is not fixed. It depends on whether the market is focused on Fed policy, yield differentials, or global risk sentiment. Segment 6: Practical tips for forex traders. So, how do you actually put this into practice? Here are some practical steps. First, track Fed announcements religiously. FOMC meetings, inflation reports, and Powell speeches can move markets instantly. Second, use economic calendars. Trade balance data, GDP releases, and jobs reports can all shift currency values. Third, manage your risk aggressively. Carry trades and Fed-driven plays can be profitable, but forex markets can turn on a dime. Use stop losses, trade with proper position sizing, and hedge when needed. Fourth, watch correlations. The dollar often moves inversely to commodities like gold and oil. Meanwhile, commodity-linked currencies, such as the Australian and Canadian dollar, tend to track global commodity cycles. And fifth, stay educated and well-equipped. This is a competitive market. The right tools and reliable learning resources are non-negotiable. Segment 7: Tools and resources. This brings me to something important: having the right trading platform and the right learning support. If you're looking for a trading platform that's reliable, fast, and intuitive, I recommend checking out crystalballmarkets.com. They offer a world-class, cutting-edge, user-friendly trading platform app that's built for both beginners and experienced traders. When markets are moving fast after a Fed announcement, execution speed and platform stability matter. And if you want to keep building your knowledge, I highly recommend Crystal Ball Markets beginner-friendly trading, investing, macro, and financial markets podcasts. They break down topics like the Fed's policy shifts, dollar strength, and carry trade strategies in clear, digestible ways. Closing Thoughts Forex isn't just numbers on a chart. It's global power, trade flows, and investor psychology all rolled into one. The Fed sets the rhythm, the dollar acts as the anchor, and strategies like carry trades offer tactical plays. To succeed, you need to understand how currency strength affects exports. Track Fed policy like a hawk. Use carry trades wisely, knowing both the potential and the risks. Equip yourself with strong tools and reliable education. So whether you're searching for the best currency pair to trade today or building a longer-term strategy, remember, preparation and discipline are your biggest edges in Forex. That wraps up today's episode of Financial Market Insights for Traders. I'm Sophia, and I hope this deep dive helps you approach Forex trading with more clarity and confidence. Don't forget, you can start trading smarter with the Crystal Ball Markets platform and stay sharp by tuning in to their financial podcasts. Until next time, trade smart, stay informed, and keep your edge in the markets.